Thank you. Welcome, everybody. I just thought I'd start with something that looks like the forward-looking statement that I urge you to look at, and I'm also giving you all fair warning that I'm going to be making some backward-looking statements as well. I thought it would be fitting in the context that we live in to provide you, as Joe did, with some fruits of what looks like 27-year career working in the mining industry, both for major mining companies and juniors, working through 3 cycles. I feel like I'm an active participant and a victim at the same time. So I think, for many of us in this industry, things kind of feel like that movie Groundhog Day, where, you wake up every morning and history is repeating itself, and the cycle looks very much like the last cycles that I worked in, with one small, perhaps, difference, and that being the issue of scarcity of resources and good gold deposits, as Joe mentioned earlier. So first and foremost, the first point, the buy, sell, and exploration discovery cycles are clearly out of sync. This is something that happened in last cycles and is happening today. Mining companies tend to sell their assets right at the top. They blow them out the door. They blow them out the door at the low end, right at the worst time. It gives us an opportunity, obviously, to do this, as a junior, to buy these assets from them at fire sale prices. Sadly, the money comes into the industry right at the wrong time, right at the peak, and obviously discoveries are sometimes made right at the worst possible time. Also, as Joe mentioned, gold producers they move very slowly on M&A. They act at the wrong times, again, buying right at the wrong times in these cycles. One other thing that I've learned, high margin gold deposits, and that's typically as it relates to grade, are becoming very rare, especially those in safe jurisdictions. Another impediment, the time required from discovery to development is becoming exceedingly long, and there are a myriad of reasons why this is, but what's being touted these days is something in the order of 8 to 12 years between discovery and actual development. Producers are relying almost exclusively on the junior mining sector to find ounces for them to replace the pipeline. As Joe mentioned in his presentation, they're doing little or no exploration of their own. So what that leads to is very flat gold production profiles becoming the new norm for these gold producers. And I'll touch on that a bit later in the presentation, but this is pretty clear. Flat is the new norm. What these downturn cycles, especially the last one, which was protracted, has led to is this massive brain drain. There's not a lot of talent left in this industry. A lot of talent has been shed off as a result of people just getting old and moving out of the industry. But there's not a lot of sort of seasoned, out of the box sort of management groups out there leading the charge here, and it's becoming pretty rare. So in conclusion of this slide, the pipeline of the exploration part of the pipeline period of assets for these majors is becoming dry. With respect to what that looks like in terms of gold discoveries, what we're seeing here is a lot of dollars into the exploration game. Used to be almost a direct correlation of dollars in versus discovery. This goes back many tens of years. Dollar in would equate to discovery. A curious thing happened in the 70s and 80s. In the late 2000s, where that stopped happening. In other words, lots of money into the exploration sector, no longer reflecting in exploration discoveries. And so this graph, in fact, shows the same thing. And as you can see there, basically that crossover happened in 2008 to 2010. So we're moving into an era where very few gold deposits are being discovered. What's further exacerbating that, obviously, is this rarity caused by discovery, which means that mining companies are moving to low grades. And this slide shows that, and then some, in terms of where we're heading in terms of average grades. Mining companies are now mining grades that we wouldn't have thought of mining 10, 20 years ago. In fact, the average grade of the 1 million ounce gold deposit these days is about 0.66 grams per ton. And I should highlight that Integra's average resource grade is about 14 times that. So as I mentioned, mining companies typically move extremely slowly in terms of M&A departments, slow to get off the mark, buying at the wrong times, mostly overpaying at certain stages of the cycle. As Joe pointed out, this has become the new norm. It used to be, even as recently as 5 years ago, you would get to a mining conference where you would go to, didn't matter whether it was Newmont, Gold Corp, or Barrick. They would show 5-year projections of gold production that were basically upward trending, and reserve growth basically upward trending as well. Now, what you're seeing is flat is the new norm, and companies are coming to grips with that. And again, this is driven by the notion of scarcity. There's not a lot left in the pipeline. In terms of where M&A has been happening, and I mentioned earlier, M&A has been quite slow of late. Where it has certainly taken place, mostly focused on North America and specifically in Canada. With respect to jurisdiction, obviously Canada is one of the best places, best countries in the world to be acquiring assets due to FX issues, due to low geopolitical risk, due to, in some cases, decent infrastructure. But one by one, each one of these participants has been picked off in the last year or two. And there are very few companies out there with assets that are sort of sitting out there waiting to be picked off as well. Joe mentioned Kirkland Lake. This slide is old, so I didn't put a red line through that one. I can wait a bit. Thanks, Joe. But that just goes to show you, the main issue here is scarcity. With respect to the M&A overview, what could be happening? This is an interesting slide. It comes from Macquarie Capital. They were gracious enough to give it to us. Upper left-hand corner where you see basically industry participants like ourselves, the junior mining companies, with assets that are growing, actual resources in the ground, et cetera. That large void, that circle that you see there, is that void that mining companies are expecting us to fill. And there are no or very few companies that are occupying that part of the space or the curve, basically to fill that pipeline for the major mining companies. And I should also point out, without naming any names, in terms of these companies that are moving along this cycle. If you're looking at the production profiles that some of these companies are pointing to, many of them don't move the needle for the major mining companies. So this is a space that Integra wants to occupy. So basically, you're probably sitting out there wondering two questions. One, when is this guy gonna get off the stage so we can have our beer? Or two, what does Integra have to do with any of this? Well, basically, we're filling that gap, and we feel it quite well. This is a graph that shows grade versus total resources in the ground. We sit in a pretty enviable position with respect to grade. We're a very high grade, 9 gram per ton average gold deposit, over 2 million ounces of gold. In terms of what's to come, we have resource estimates coming out, one that's imminent and another one which we're calling the mother of all resource estimates in the first quarter of next year. That's going to move us sideways along that graph. The 4 pillars of what Integra is, simply put, jurisdiction, as Joe mentioned, this is something that everybody's looking at now. Quebec could not be a better place to own and operate a mine or even an exploration project. In terms of permitting, Quebec could not be more supportive. Infrastructure is phenomenal in this case. Capital efficiency, our project comes in under $100 million, and I challenge anybody out there that can show me a project that can produce 110 to 130,000 ounces per year over about 10-year period. That comes in at a capital capex of under $100 million. Low cost of production, our last PEA, the last input that we had, or output from the last PEA, $730 Canadian per ounce was our all-in sustaining cost. So what we have is a phenomenal margin, and I guess all this is summed up by the fact that we have phenomenal grades. As I mentioned, 9 grams per ton gives you a great cushion and a great margin to work with. Shares outstanding, 475 million shares. We currently have about $45 million of cash in the treasury, marketable securities of about $8 million. And we're basically owned by all the usual suspect funds out there. 2 minutes. All right. With respect to our share price graph, obviously nothing to see here other than we're very news-driven as a company, outperform the GDXJ and most other metrics that anybody would want to talk to. I'll skip over that one. This is the evolution of our deposit with respect to how it was back in 2013 versus what it looks like today. And I can say that what you're going to see in the upcoming PAs, this monumental shift of what was previously higher cost room and pillar mining to lower cost long hole mining on the right, and that's going to be the subject of a PA coming up. Lots of high grade to go in there. And again, we've advanced underground with respect to this transition from an exploration company to a developer and a producer. And that's happening now. We've got a ramp that's going underground. We're now about 325 meters underground. And again, we're making that key transition from exploration to developer and producer. Fire sales, you want to talk about the best fire sale ever. I think in the last 5 years, we acquired about $100 million of milling facility, a fully permitted milling facility right across the street from our discovery at Triangle. And we acquired this for the paltry sum of about $8 million in cash and stock. Exploration, we're very active, 6 drill rigs active and underway, 4 on the Triangle deposit itself, 1 on this great target called Lamac Deeps, and 1 working right across the street from our office. If you walk away with nothing else today in terms of the exploration sizzle of this story, this is a target that we're drilling right now. Left-hand side, the Sigma mine, where I started my career in 1988, produced 4.5 million ounces down to 2,000 meters. The Lamac mine, similar amount of gold produced, 4.5 million ounces down to roughly speaking only 1,000 meters. Where these 2 ore bodies intersect has never been tested, and we're in the process of putting down a 2-kilometer pilot hole to test these zones. We think that there's a very high potential target, in my view, the best target in Eastern Canada being tested at the moment. We're also testing targets, as I mentioned, right across the street that were right under our nose that we didn't know about until the Gold Rush Challenge. This is a magnetic anomaly with 2 high-grade hits into it that we didn't know about. We're drilling that now. We're good to go? Yeah, I'll wrap it up. So in terms of what's coming up, obviously we've got the PA coming. And the next PA is due out in January. The guidance that we're giving is 110 to 130,000 ounces. CapEx is probably not going to move very much. And things are looking good. So look out for resource estimate, which is imminent. Updated resource estimate, the PEA coming out in January of this year, which is going to look stellar. And then the mother of all resource estimates to come in March. Thank you very much.